How are you guys profiting? Because you're doing a lot for these big institutions, but how are you guys generating revenue?
So we're charging 5% on each side. Yeah. So with the protocols, we go to the protocols and we set them up with this. That's been extremely successful. We've found a very strong degree of support. People like our friends at Redacted, Rage Trade, the guys at Velodrome have been fantastic. Bite Masons, the Urine guys are incredible. I'll say that. We charge 5% on that upfront payout that they make to whoever's taking the other side, typically the institution or the whale, and we pocket that. And then on the other side of that, we know when they're claiming the interest, we charge 5% on that. We don't touch principal. I don't like touching principal on these things. It's a good way to drive business to competitors, but by touching performance fees, yeah, good way to make money.
How much runway would you say you guys have? Because that's a major question that a lot of people have very common. Are you guys profitable right now, or are you leaning into the runway and then you're going to be hoping to pick up in the future? Give me some insight into that. What's going on, everybody? This is Professor Crypto Banana, and today I'm talking with Rob from Revest Finance. Since I last had him on the show, they have come out with a new product line called Resonate. And from what I understand, it allows you to get your yield up front. That's one of the major benefits. Your deposit is still liquid in the form of an NFT, and I'm going to want to understand this better. So I'm going to be hitting Rob with a lot of hard questions. But before we get started, this is a disclaimer. Everything in this video is just for entertainment and educational purposes only. I'm not getting paid or sponsored to do this interview, but I do want to be transparent in saying that I am invested in this protocol. So with that out of the way, welcome back.
Great to be back, Professor Crypto B. It's been a while, man.
Yeah. So since the last time I had you on, you were really focused on financial NFTs and building out that product. So now you have Resonate. So can you give me the quick 1-minute speech about what that's all about?
That in a lot of cases, people want stability in crypto, but crypto lacks stability. We can talk about prices all day. There's a million different protocols that try to address that, perps being, chief among them. But when we start thinking about rates, well, those are very unstable. Now, for some participants in the space, especially whales, institutional finance, people need stable fixed rates because having those fixed rates allows them to set up other financial products that guarantee them a certain amount of success no matter which way the market moves. But right now, rates are incredibly variable, as you know. So what Resonate does is it's able to offer people who have that preference for fixed guaranteed rates an upfront payment. Let's say the variable rate is projected to be 5%, could be 5, could be 3, could be 2. We're going to go ahead and we're going to give this person who wants a fixed rate, who's like, I like 5%, but I'm willing to take less as long as it is fixed. We're going to pair them up with someone through Resonate who will pay them 4%. And so they get that 4% upfront in dollars, in tokens, whatever. As long as they get it, they're happy. They lock up their principal, which is then made liquid via FNFTs, and they're done. They've got their guaranteed 4% rate. The guy on the other side, he's a different type of participant. He's either a protocol who can really, reliably predict what the rates are going to be, and therefore is like, yeah, I know this is going to be above 4%, so I'll give him 4%. Or he's a degen, someone who's wants to play with a little bit of leverage, because that rate hits the predicted 5%. Well, 5 divided by 4, he paid out 5. He paid out 4, he got 5. His return is 25%. So he was able to lever up and take on all of that risk. Of course, if it only hits 3, he loses. But, he's willing to take that risk. It's a transfer of risk from someone who doesn't want that risk and is willing to accept, potentially losing upside to somebody who does want risk and who wants more upside.
But that would be more across an extended period of time, right? Because it'd be more in terms of yield farming, etc. So you're betting over the course of a long duration that the rate would be more towards 4%, 5% or higher, not right off the bat.
Well, the rate will be over a period of time, yes. So we found out that 2-week periods work best. And 4 or 5%, that's numbers that I use for convenience. Really the highest thing you're going to see in a 2-week period is 1%, 2% within that range. But within that range, those can they can vary wildly. I'll give you an example. Our
Sure.
first inaugural trade with an institutional fund that we put through a few weeks back was with Coindex. And during that trade, we started off the assumption that the yield on Y curve, Urn curve, was going to be about 30% annualized, which meant that it would be around 1% over the course of 2 weeks. Now, I paid them, around 1% up front. And they were expecting, I was expecting, okay, I'll get a little bit above 1%. But because of all that craziness with Avi Eisenberg and the curve drama, Y curve rates went through the roof. And I ended up with 2% over the course of those 2 weeks. Now, I just as easily could have, curve could have completely gone down the toilet. I could have ended up with 0.1%. But rates can vary wildly in very short amounts of time in this space. And that's why these institutions, these bigger players, that's why they're interested in finding stabilized ways to get that, even over periods as short as 2 weeks.
So when we're talking about certain rates and percentages, it sounds like for major institutions, maybe whales, more geared towards them. But what about for the retail investor? Because, for example, let's say if I have $500 and I could potentially be looking at yield farming and getting as much percentage as I can back, 1 or 2% wouldn't necessarily appeal to me. But from your previous case that you just mentioned, this is a major deal for hedge funds and people with a bigger balance sheet. Is that right?
It is. Retail is an interesting situation. I think retail, there are participants who are looking for more fixed rates, and for them, we do have that offering as well. It's not gated; anyone can use it. But from what I've seen of the retail who's in crypto at the moment, they're looking for very high rates, especially in short periods of time. And Resonate actually offers that on the other side of the trade. So remember how I said I paid out, 1% and got 2%? Well, I actually got back double what I put in. So I didn't get 2%. I got 100% return
Hmm.
because the return to the person who's making that upfront payment, it's not proportional to what the actual interest rate is over that period of time. It's proportional to how much they put up.
I see.
And they're putting up a much smaller amount because 1% of $100 is only $1. So, you put up $100 of principal and I give you $1 of upfront interest. Okay, now I've got the earning power of $100 that I've rented from you for 2 weeks by paying you that rent ahead of time. That's really a good way to think about this. Is it's a rental of capital. You're renting your capital out to me in exchange for getting paid upfront, a guaranteed amount, no questions asked, no BS, just one and done. What that means is, since I paid you such a small amount, I've got the earning power of this huge chunk of capital. Let's say that the rates that I expected, I paid you $1. I was expecting 1% 2 weeks. And instead the rates are 2%, like they were for me. So now I got $2. I paid out 1, I made 2. It's only been 2 weeks. That's 100% in 2 weeks.
Okay, now when you put it like that, that makes me think differently. Because
Yes.
before I was thinking about 1, 2% on my principal. Let's say I came in with $100 and like, okay, I got back 101, 102, $2 profit. Doesn't mean much. But it seems that you can put upfront $100 in terms of the yield, and then you get back, let's say, $200 in this example.
You can. You
Dang.
need a lot of capital depth for that to happen. But fortunately, institutions and whales just happen to be the people who are looking for a lot of capital depth.
So like let's say I am looking to make I'm going to put $100 for my upfront yield to somebody else because I'm like, I think this is gonna go up a lot more. Do I
Yep.
have to also back that up with, let's say, the $1,000 LP token with it? And then I give also the $100 on top as the cherry. I'm looking to make that profit. Or can I go in strictly with $100 for that interest, looking to get back that $200 profit?
You can go in strictly for that interest. That's the purchaser side of the agreement. What this is very similar to an order book. You have to have a counterparty. So you have to have an institution or a whale who's willing to put up their principal and accept your upfront.
Hmm.
But presuming you have that, which we're working and succeeding at sourcing right now, then yeah, you have that depth that you need to be able to say, yeah, here's $100. If it does hit two, I get 200.
So
Um,
tell me more about these big institutions and whales and potentially hedge funds.
so these are guys who've been wanting to get into the space. Um, I'm friends with a few funds here in Atlanta, and from what they've told me, they've been interested in what we call pool two farming for a while, which is LP token farm. They aren't easily able to get into it, both because of impermanent loss, which Resonate does help to prevent, and because of, well, just having to worry about these variable rates. They want to get into these other more single asset farms as well, but they can, but then they run into the problem that a lot of times the rates will go down on that farm, and they will have expended an amount of money getting into the farm, and the returns will actually now be eclipsed by the expenses. So if rates go down on a farm they're in, then they end up in a position where they haven't made money. What a lot of these guys do is they will buy a position on a farm, and then they will buy a short perp to hedge that risk. Now, in the bull market, things were perfect with that. That was a great strategy because everyone was long. So, if you're familiar at all with perps, you know that whichever side is bigger pays the other side to provide their side of the equation. It's called
Hmm.
the funding rate. The idea being that, if you have all this capital over here and just a tiny amount of capital over here, well, you got to subsidize the tiny amount just to even have that tiny amount in the first place.
Right.
So what a lot of these guys would do is they would enter on the short side and they would actually be getting paid to short. And then they'd go and they'd enter their tokens that they had now shorted and gone delta neutral on, which is where you've taken out a long and a short on an asset. And they would go and they'd farm that long. And then since they were getting paid to short, it didn't matter what was going on with the rates. The rates could fluctuate. But now, because everyone is short, since everyone is terrified, um, they're in a position where this rate fluctuation does actually matter a lot. So being able to have that guaranteed rate means that they can better provide their own strategy. And don't ask me to get into what a spread is. I don't terribly well understand, but I understand that they do need a fixed rates to be able to produce good spreads on the interest rates. So they can do that, and they can also be able to say, yes, we're getting this guaranteed amount up front, and we know what the expense is going to be. So now, is this a profitable trade or is this not a profitable trade? Their whole thing is certainty, since they have to be able to provide a guaranteed return. Same thing with whales. They're whales because they are extremely careful with their money. And so when they want to go and do a yield farming scenario, okay, well, if they've gone delta neutral on the asset, they need to know the exact same thing. Am I going to be able to get a fixed rate of return here? Am I going to be able to reach a certain threshold, at which point this trade becomes profitable? And if I have that uncertainty that something might fall off and I don't reach that rate, then I'm not going to enter the trade. That means that we have lower liquidity in these spaces, and that causes all sorts of other problems in crypto. What Resonate can do is it can guarantee that there will be a certain rate in these spaces. And what that means is that these participants can now take advantage of these opportunities, provide liquidity into those spaces, bring in those large chunks of money. And in bringing in those large chunks of money, they increase the stability of crypto overall. The deeper the liquidity, the more stable the system is. Our long-term view, we see Resonate replacing a lot of the existing paradigms over time, wherein things move more and more toward fixed rate solutions. If you're a protocol right now, you have a problem. You can't sustainably incentivize liquidity. The purpose of incentivizing liquidity is to have a deep base in your token so that your token can be used for other transactions. For example, lending, large transactions. You can't grow if there's not deep liquidity backing your token, because otherwise, if I have 10 million to deploy and you have a $1 million liquidity pool, the slippage will prohibit me from ever entering that pool, because I'll drive the price to the moon and everyone will dump on me. It's the tyranny of low liquidity. It's one of the biggest problems in crypto right now. So how have people been incentivizing people to come in? They've been doing liquidity mining, and liquidity mining is problematic because it creates a Ponzi. It creates this broken incentive alignment where, okay, I'm paying out rewards, paying out rewards, paying out rewards. The minute things start to look bad, first guy out the door from that liquidity pool, well, he is the only guy who's going to make a lot of money. Everyone who doesn't sell as quickly as they possibly can, they get dumped on. The price goes down as that guy who dumped first is dumping his tokens into the pool, and it triggers a runaway death spiral. We saw this a lot the last cycle. Liquid Driver is a good example. They had 30% of their LPs pulled. People were wondering, how the hell is Liquid Driver dumping? They have 70% of their tokens locked up. Well, the other 30% of that was LPs.
Ooh.
And once a pool starts turning in on itself, it begins to squeeze all of the value out. We have a very broken feedback loop here. You can see it going on with SushiSwap right now, where they're starting to actually run out of tokens to pay people with because they've been burning their tokens so much into these pools. Where we see Resonate heading is Resonate offers this rent to own model. That's actually some of the brilliance behind it. As a protocol, let's say you start out with a traditional liquidity mining model. Let's just start from an existing protocol with an existing model. You start coming in on the purchaser side. You start offering institutions and whales these fixed rates from your protocol treasury. And you can do that a lot easier than other people can, because when you're paying out up front, you're not exposed to the opportunity cost. If the token goes down in price, you don't care as long as you get more of the token, because you're the protocol. You're stuck with the token anyway. You can begin to accumulate your own protocol owned liquidity by doing this, since the return that you get on the over time is, a larger return. It's in LP tokens as well. So now by paying out up front with these tokens, you're accumulating more LP tokens than you're paying out in value, right? If you think about the bonding paradigm as it currently is, with LP tokens, you have to sell them at a premium. So if I want to buy one LP token that's worth 2 tokens, I pay out 2.5 tokens to purchase that. That's how bonding works. But through Resonate, you're actually paying out, 1 token, you're getting back 1.2 tokens worth of liquidity. So already beginning to accumulate protocol owned liquidity even at this early stage. You can compound this by offering early buyouts to people who suddenly need to get access to their assets. This happens to institutions a lot. Whales, not as much, but anyone who foresees a short-term dip and is suddenly terrified and needs to get out before they get crushed, you can offer them buybacks. You can offer them at a metered amount of tokens. So that way you don't trigger a death spiral. All of your LPers are locked up, which means that, they can't dump on each other anymore. And you say, okay, I'm going to buy out, 10% of you for this many tokens. You accept that you're going to get dumped on a little, sure, but you know how much you're going to get dumped on. And you're able to pay them, say, 0.8 tokens worth of 1 LP token. Now you're acquiring more POL. So as this goes on, you start transitioning from a traditional liquidity mining model to a true fixed rate model powered only by Resonate. And what you're doing now is you've got protocol and liquidity. You're happy with it. You're feeling good about that. When you need more liquidity, you can just put up an offer in Resonate. Say, I need to have surge capacity for the next 4 weeks because I know that the market's heating up and we need to get ready for all these buyers who are coming in. So I'm going to offer up, 30% for a 2-month lockup. And anyone who wants to provide liquidity, come in, lock up your LP tokens for 2 months. I'll give you 30% right now. So that incentivizes very different behavior in your liquidity providers. First off, you're able to attract capital that wouldn't otherwise participate, stuff like institutions, because they know exactly how much they're getting. They can hedge their, exposure, and they can enter this position without having to worry, is this going to be profitable? Is this not going to be profitable? What's going to happen? The other angle here is that because your liquidity providers are getting into this over time, on something of a rolling basis, since again, these are FNFTs, if you lock today and I lock tomorrow, then you'll unlock in 2 months and I'll unlock in 2 months and 1 day. So not everyone's getting out of this at the same time. What does that mean? That means that it's very unlikely that you have a lot of liquidity tokens that could trigger one of these death spirals out there in the market at a point where something would trigger a death spiral. So not only have you offered better incentives for these institutions, these whales who want these fixed rate returns, you've also set it up so that everyone who's providing liquidity can do so in a much safer and happier way, where it's no longer a prisoner's dilemma of, I got to screw you before you screw me. Now it's a benevolent cycle where, oh, okay, I just lock up my tokens and the other guy, I don't have to worry about him. I don't have to worry about the other guy. And the more of us who are doing this, the more stable the system becomes.
So by having people lock up their tokens and through different dates, etc., that stagger prevents the death spiral, is from what I'm hearing.
Yes. So the protocol incentivizes people into locking up their tokens. The larger the percentage who are locking their LPs, the more stable and difficult to trigger a death spiral it becomes. Because there's fewer and fewer people who are holding liquid LPs and are able to trigger that spiral. That also means that you can start attracting real institutional money, because real institutional money wants to know that a death spiral is impossible. That's a huge risk. That is a counterparty risk that they are taking whenever they enter a liquidity pool. But if all the people in the liquidity pool are also locked up, and you've been able to establish this baseline of protocol and liquidity, which, by the way, is why POL is so popular, is because it establishes a baseline. Well, now it's much safer for big players to come in and participate, since they no longer have to be worried about these risks that are present in more freewheeling systems.
So where do these protocols get their own token? That may be a dumb question, but you said that protocols will have their own token. They're kind of stuck with it. Are they accruing more tokens over time? Are they looking to acquire their own tokens back? Give me some knowledge here.
So most of the time, protocols do have a treasury, and that's a result of the way that token raises are typically structured. You often allocate a decent chunk of your own token for future DAO activities. Everyone has their own labels for it, but it's just a chunk of tokens that aren't circulating. And normally they just sit there, they gather dust. Our insight is that those tokens can be put to work in a safe and sustainable manner, and that if they're put to work properly, they can allow the protocol to accrue more of their own token back off the market. The way I see this is almost like market dependent liquidity management is a good way to describe it. Let's say the market is up. Let's start with up. All right, people are staking a lot, but they still want upfront yield. So you, the protocol, this is in the context of a traditional liquidity mining system, not in the context of a full Resonate solution. You, the protocol, you're looking at this thing and you're like, okay, let's see if we can pull some of those emissions back off the market. So for people who want to get paid up front, you offer them, payout in your token at slightly below market rates, but a fixed rate. Especially early on when rates are highly, susceptible to change based on how many participants are in the system, a lot of people will take that deal. And that means that since you knew the rates and you were able to set your payout based on your knowledge and projections of what the rates are going to be in the next month or so, that you were able to design the system to guarantee that you got more tokens back in off the market than you put out. You satisfied people's short-term desires, and you look to the long-term stability of your token by, giving up that short-term gratification. Because to you, a protocol, the short-term gratification doesn't matter at all. It's a completely different set of incentives, which is why this thing works. Because the protocols have a much longer view than people who, invest, institutions, whales, people who have more short-term capital gain. I need to have short-term gains. So by paying them out up front and giving them stability, you get more tokens at the back end, and that allows you to start accruing more tokens. Let's move down to when the market's down. All right, you've been slowly reducing your burn by doing this because presumably you're still paying out emissions. Now the market's down, you can even start to consider deploying some of that protocol and liquidity, splitting it in half, using the dollar component to power buybacks from that same emission stream. Let's say you have a revenue stream. You can put that to work to power even more powerful buybacks because people want to get paid out now. Most people don't want to wait. People are impatient, but they also like, guarantees.
So when it comes to institutions, Are they concerned about regulation? Because when I think about institutions, I don't think that they're coming into crypto. They're looking at this aspect because they'd be concerned. But from what you're telling me, they are interested. They are there. So can you tell me more about the risks associated with, let's say, regulation and getting into, let's say, Resonate and other products?
When you're thinking about regulation from the institutional side,
Hmm.
you have a lot of special purpose constructs that you're using to be able to participate in crypto at all. And in that regard, Resonate is no different than using something like Yearn, right? That's the thing, is that in the current state of affairs, if you want to be an institution participating in crypto, you have to check an awful lot of boxes. There are people who are working to change that, but there's already $20 billion here right now that has gone through that track, where they have gone down the path of, okay, we have to get this special purpose vehicle set up in the Bahamas. We have to be able to spin up companies on an ad-needed basis. We have to do all this lovely amount of paperwork. And hey, now we can go play in DeFi. But there is a very well-defined track for institutions who want to participate in crypto. And there are a lot of small funds currently growing aggressively now that a lot of the big guys have been washed out. Very recently, we saw the deaths of some of the former titans of this industry. And in that atomic wasteland, these smaller guys are growing rapidly. They're able to take assets because they've got these structures set up. They're able to take assets from normal groups, pension funds, right? Large, normal accredited investors. And then they're able to take those funds, deploy them into DeFi strategies, make money on them, and then give them back their investors in the dollar. So regulatory wise, I would say there's not much of a consideration or concern. I don't know the specifics. I do know a lawyer who sets up hedge funds in this regard,
Hmm.
and he's done this for probably hundreds of institutions at this point. The real reason conventional institutions are in this space has to do with the terms. So if you look at these guys, they have structures that says we're going to have crypto assets on our books.
Hmm.
This is something we do as a fund. But traditional funds are very regulated, and what they can have on their books is very clearly defined. And what is and isn't allowed is relatively clearly defined. Crypto falls in a bit of a gray area unless it's specifically said, yeah, this is part of our plan. So a lot of these guys have been around a long time. That's not really part of their original plan or their original, MO. And they can't just take their investors' money and throw it into something they didn't say they were going to be investing in. So slowly you're beginning to see the bigger firms spin up special arms to do crypto assets. But a lot of the growth that we've seen so far has been new firms entering the space, specifically with the objective of we're going to go invest in crypto. If you give us our money, this is what we are going to do with it. It will be in crypto. And like I said, I'm not terribly familiar with the regulatory side, but as best I can tell from having these conversations, that's generally why we haven't seen people like BlackRock just show up and start playing in DeFi. There is also the liquidity side of it. That's another side.
But you're telling me that smaller institutions are coming in during this bear market and they're profiting and they're growing immensely.
Yeah.
Wow.
I wouldn't say profiting immensely. I would say they are growing quite aggressively.
Growing quite.
To give you an idea, the guys I know are not up a lot, but they are up. And in this market, that's impressive. That's incredibly impressive. I'm not up for the year. I'm down bad, man. I'm sure you are too.
But see, and that is something that I don't hear about and I don't know much about. So this is why this is news to me. We're like,
Oh yeah,
yeah,
they're people who are just like you and me. They're good traders, though. Like, I mean, you might be a good trader. I'm a decent trader. These are guys who are excellent, who've been around, 5, 6, 7 years, and who realized sometime in the past few years, wait a second, we're actually good at this. We have enough CFI knowledge and CFI background that we can bridge this gap. Why don't we just go open a hedge fund? And then did. And being, what we would refer to as either whales or whale adjacent, they've done excellently. A lot of them are our people. That's the thing, is it's not so much that CFI is coming into us as it is that a lot of our guys are going into CFI.
But they must be looking at CFI for some of the techniques and proven principles and applying it over here to the
100%.
crypto
I
side.
mean, that's the thing. Is like I said, these guys they have the knowledge, the CFI knowledge of how good trading strategies work. I mean, that's where this industry is headed.
Looking at what Resonate is doing and saying,
Yeah.
now you're providing those tools where they can use similar, they can actually implement those techniques from traditional markets
Yep.
over
I've
here
heard
in
it
DeFi.
compared to an interest rate swap. That's the most concrete comparison I've heard so far. I've also heard it said that I've invented a novel financial instrument that has no corollary in CFI.
Mhm.
But that's generally the gist, is they're bringing their understanding of how things work in those markets and what's needed to make those markets work, and they're applying it to DeFi. DeFi is obviously different. You can't apply everything, but you can apply some of the elementary concepts. If you just come in here though and set up a CFI business, it's not going to work because we have different needs. But if you apply the investing fundamentals, yeah, that works.
So how are you able to reach out to these different hedge funds and big institutions and attract their attention and say, hey, look at us, come over here?
It helps when you tell them that you can get them 27.5% stable APR in a delta neutral fashion. That definitely worked for us pretty well. Generally, when I'm trying to get in touch with these guys, I'm networking. That's been my biggest draw so far. I'm trying some new things where we're going through funds of funds is the best term I can come up with. But again, that's through networks. It's getting in touch with people who know somebody and saying, "Yeah, you're my friend. Can you introduce me to this guy?" The introduction gets made. I say, "Hey, have you heard of what we're doing?" They're like, "Oh no, that actually sounds really useful for what we're doing. Uh, let's talk." And that general growing awareness has meant that we're bringing on more and more of these trades.
So you find a happy customer, in this case, bigger institutions or institutions in general. They're happy with what's happening here. And you say, hey, can you hook us up? Or they will even reach out to other people that they know and say, like, hey, check out what Rob's building over there at Revest Finance. And now they get in as a word of mouth, as opposed to you doing heavy marketing.
Yes, I would say that. I would say marketing in this case is more how we present ourselves and less about spending a bunch of money on Twitter ads.
Fair
You're
enough.
going to get a lot better reception with a warm intro than
Mhm.
you are with just spraying and praying.
Is that a Counter-Strike reference?
Oh, absolutely.
Oh, I love it.
We see retail in this sector a little bit in the future. We just also happen to acknowledge that retail is not really present right now. The demographics that make sense are the ones who are here. And that's protocols and that's institutions.
So you know your target audience and you're going hardcore on that right now, as opposed to the, hey, we're going to try to get everybody, not know your demographics. You're very targeted and disciplined in who you're trying to help.
We're very targeted in what we found to be successful high volume trades. It's the only thing that makes sense in the current economy is figuring out this guy will use my product, this guy will use my product. All right, let's deal exclusively with those people, build a sound amount of volume, aggressive amount of volume. And once we've honed in on, 5, 6, 7, 10 trades, then we start to leverage that growing awareness into something of a network effect, because they'll tell their buddies will tell their buddies. And it begins to snowball. Once you have that, that notoriety, for lack of a better term, you can actually start talking to some of these bigger central points, these funds of funds, who can then connect you down through their network.
So therefore, what's in it for Revest Finance for you, Rob? How are you guys profiting? Because you're doing a lot for these big institutions, but how are you guys generating revenue?
So we're charging 5% on each side. Yeah. So with the protocols, we go to the protocols and we set them up with this. That's been extremely successful. we've found a very strong degree of support. People like our friends at Redacted, Raise Trade, the guys at Velodrome have been fantastic. Byte Masons, the Yearn guys are incredible. I'll say that. And what we do there is we charge 5% on that upfront payout that they make to whoever's taking the other side, typically the institution or the whale. And we pocket that. And then on the other side of that, when they're claiming the interest, we charge 5% on that. So we don't touch principal. I don't like touching principal on these things. It's confusing and it's a good way to drive business to competitors, put it that way. But by touching, performance fees, yeah, good way to make money.
The audience may be wondering, they're looking at Revest Finance, bear market. How much runway would you say you guys have? Because that's a major question that a lot of people have very common. Are you guys profitable right now, or are you leaning into the runway and then you're going to be hoping to pick up in the future? Give me some insight into that.
So we're currently running a raise, and I'm happy to say that so far things are looking good. Got I'd say roughly 6 months at this point, which is, I guess that may sound small to a lot of people, but that's actually quite generous.
Hmm.
So
So tell me more about these raises. So that means, do you go to like venture capitalists or bigger
we're
investors,
dealing with venture capitalists.
and you're saying we need to be able to function and keep going. Therefore, we will give you like a certain amount of tokens or percentage of the protocol, and as a result, that allows you to function for another 6 months.
Yeah. Oh no, you want, so the goal, the way it works in startup world is you want about 18 to 24 months. That's what you want. That should be your goal to get during any raise. But once you hit about 6, 8 months, that's when you start raising. That's how that equation works. So we're going to these venture capitalists and we're saying, we are building this. This is our vision. This is where we think we can take the industry. We're going to build this into the one-stop shop for liquidity. We're going to fix the big underlying problem in crypto, which is these broken feedback loops, in such a way that we can bring in billions to space. And we can be the engine that drives that liquidity management of crypto. So we go to these guys, we give them the pitch, they give us checks, we give them tokens.
So then what does that mean for, let's say, the retail investor that's looking at that? What are some of the downsides and risks of having venture capitalists investing into you guys?
So the downsides to the retail investor, I would say there's always the potentiality of having the VCs offload at an unfortunate time. Everyone knows, how these things went down the last cycle where retail was used as the exit liquidity.
Mm-hmm.
The upside to retail is the VCs do provide a very important service to the space, which is that they keep projects funded when retail isn't there. That's the thing, is good ideas will always be around, but at the moment, retail capital is not so much around.
So if you are making 5% off of the interest and the yield, etc., and that is your income, are you looking to upgrade and do more partnerships and get more people involved? Because it sounds like that is not enough to like help you extend your runway, hence why you're going out to the venture capitalist.
No, I would like to say that we are profitable at this point, but we are not. That'll be around 100 million TVL in our system, at which point we are profitable.
Okay, and how much TVL do you have currently?
About 500.
Oh, 500,000?
500,000.
So that seems like a long way to go. So therefore, in order to get to that 100 million TVL, what is the plan? Is it still through the networking of other people and hoping that becomes a snowball effect and then you hit that point?
You got to get a few good trades. That's the thing. You get a few good ones, and then you scale, right? What is that saying? They say, don't do anything that doesn't scale. Small trades are the way that you prove yourself to bigger players. And when those small trades work out for your smaller partners, then you're able to go court the big ones. And okay, now so right now we did a test strip of, I think, 50,000 a few weeks back. Now we're talking about, hundreds of thousands. All right, we do hundreds of thousands. Okay, hundreds of thousands works. Now we're talking about millions. Okay, we've done millions. Oh, okay, cool. Let's go do tens of millions. And that's, I guess, the best way to describe the progression as I see it is some of these players, some of these large groups, they're not playing with, $1 million. They're playing with 10, 20. I mean, a small fund would be a $50 million fund. You're not talking about small amounts, these guys. Like, I'm aware of at least one who's playing with 300 million just casually. And that's a small allocation. That is a test strip allocation. I was talking with a friend the other day who was talking about a $50 million test strip. Because these guys, remember, they are funded by big groups who are even bigger. When you're talking about somebody like a pension fund, 50 million is the drop in the bucket.
So your mindset is not concerned about, okay, we're only at $500,000 and then
No,
100 million. That is such a huge step. You're
no,
like, no, this is an exponential curve because as
it's an
soon as
exponential curve.
you
It's
establish
all
that,
about
it's
proving the system works. And once you've proven the system works, and you've got the trades with the deep enough liquidity to support those massive trades, it's easy.
So a natural question then is you mentioned that you have a lot of friends that do play with a lot of capital. It's not that big of a deal to them. Why haven't they taken just if it's a drop,
Yeah.
chuck that into Revest and
Oh,
also
yeah.
Resonate, and then boom, you're already there. Like what's
Fear.
holding them back from doing that if you're well connected?
Fear. I said it 3 times. That's probably enough to hit the mark. Everyone's terrified right now. The people I brought in, they're still playing. But a lot of people who have really big allocations, they're looking at what just happened with FTX. They're hearing the rumors about Binance, which personally I don't entirely buy, but there's a lot of fear out there. Everyone's just thinking, I'm just going to sit on my hands and ride this out.
Watch it, right?
Yeah, exactly. It is probably the worst capital market we've had in the past 30 or 40 years at the moment in terms of, allocations in crypto, in terms of willingness to take deals in crypto and playing DeFi. DeFi is getting better, mind you, but everyone is scared. And that means that growth is slow at the moment. Now, I'm well aware the macro is going to improve. We're headed into a new year, be a new quarter. People are winding down their allocations for the year, and come next year, there is less fear. Oh, let me put it this way. A lot of people saw what happened in November and said, we're out for Q4. Done. See you next year. And come next year, things are going to start to heat up again.
But not financial advice. This is just your mindset.
No, definitely not financial advice.
Nothing in this video.
We are at the most likely bottom. Now, not financial advice, but yeah, people are scared, and that's it. It's hard to get people to take big deals right now. You can get people to take small deals just to see how things work out, but playing with really big money is something that people are afraid of.
So talking about fear, people are concerned about hacks, exploits, etc. And it seems that with Resonate, are you guys keeping those funds in a vault? And if so, what can you do to reassure people that your security and everything is uptight the best? Because I'm assuming that you guys are aware of that and you're putting in a lot of effort to make sure that those funds are safe for big institutions.
Yes, we are. So we utilize several layers to protect our investors. Well, investors is the wrong word, depositors. We utilize several layers of security. We had 2 audits on Resonate pre-launch. We had a private bug bounty pre-launch. We've had an immunified bug bounty with a reward of $100,000 running for 2 months at this point, and so far so good. We don't actually allow smart contracts that aren't registered with our system to interact with the contracts. We, when funds are deposited into the system, they are sandboxed on a per pool basis. And I don't think I got into the pools concept too much, but for every trade with a different payout, there's a different pool. That means that, yeah, it's very similar to Revest, where you'd have to compromise all of those things at once, and you'd have to go vault by vault by vault to take anything. Within that further, we only have these things plugged into farms that we trust, and that's how Resonate works, right? Where's the interest coming from? Well, we're plugging into yield farms. I probably should have mentioned that. Yearn, Beefy, and Reaper are our 3 biggest providers at the moment, and they all have sterling track records. They all have well-known, well-tested software, and yeah, it's worked great. We had an awful lot of audits. We threw an awful lot of fuzzing at this tech. I paid out about $15,000 in private bug bounties prior to launch so that I didn't have to pay out any post-launch. We have the best, oh, I won't say the best, we have some of the best security in this industry, and I'm very confident in our review process. That comes from a battle-tested place. We know what it is to have bad security. We know what it is to learn why and how to have good security.
So tell me more about how you learned. Was there a pass exploit, and how did you handle it?
Revest itself was exploited about 9 months ago. That was an unfortunate situation, and the issues that allowed it to happen have been completely resolved. We brought an entire new security paradigm following that. We brought in an external review to somebody who works for one of the big auditing firms auditing bank security to take a look at our internal practices. We brought in 2 smart contract auditors, Zellick and Blocksec, who also performed the audits on Resonate, and we set up a bug bounty. So we figured out after that issue, yeah, these are the things we should have been doing. I never, ever want to feel that way again. So we've taken every possible precaution to ensure that Resonate is rock solid.
Beautiful. So knock on wood, one could state that from a hacker's point of view, $500,000 TVL, like I assume it takes a lot of time to figure out how to exploit it. So it may not be on their radar. But once you do start snowballing up, let's say a hacker does focus on getting some of that $100 million TVL, et cetera, and they were to unfortunately get a portion of that. Would you have a game plan on how to handle such a situation? Or is it just like, what's that?
We have emergency stop systems,
Emergency stops.
and we have a program in progress to automate emergency stops. What are emergency stops? You may be wondering, it's a way to basically turn off the protocol. Like I said, you have to go one by one by one. So let's say that somebody figures out a way to actually get access to one of those. All right. We have systems under development that can automatically spot if that's happened, alert, and then shut down the entire Resonate system, preventing any further access to value pending multi-sig reactivation.
So my awareness of the actual coding and protocols is limited. If there would be a hacker and he was successful in actually exploiting, perhaps he has a smart contract that goes like super fast, would it be a race between your emergency stop and a smart contract?
There's some emerging tech that allows you to front run them. That is a thing. What I'm talking about is more like, oh, they got $1,000, hit the emergency stop, prevent any more theft. But there are also some groups that I know who are developing systems to front run exploiters. Yeah. There's a lot going on in that arena.
Rob, thank you so much for coming back on and giving me some education, hopefully the audience as well, about DeFi and all these other paradigms, because these are things that I don't necessarily understand. So thank you so much for coming on. And what's the best way for the audience to follow you and keep up to date with what you guys are developing?
I would definitely suggest following our Twitter. That is our one-stop shop for all things Revest and Resonate.
Beautiful. Well, that does it for today's video. Make sure to like and subscribe, and we'll see you in the next one.